You're listening to Uranium Spotlight on Tuesday, May 13, 2025. Brought to you by PurePoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, PurePoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, the EU looks to ban Russian uranium, Niger's battle with Orano heightens, and Denmark backs nuclear. The uranium spot price closed last week at $70 a pound, up 90 cents from the previous week's close at $69.10. While trading volumes were light, pricing continued to firm, highlighting ongoing tightness in the physical market. Only 4 spot transactions were confirmed last week, totaling roughly 1 million pounds U3O8 for the first 9 days of May. 2 of these were for prompt delivery, while the rest reflect a growing interest in the 7 to 12-month window. In fact, pricing for delivery later this year, especially December into early 2026, has firmed into the low $70. The current market dynamic appears to be a pause in trading activity, not due to a lack of interest, but because utilities are busy responding to and evaluating new procurement requests. Several recent RFPs, some calling for midterm and even longer-term delivery, are now in play, and market participants are waiting on the results. This isn't just a short-term flurry. We're seeing stronger interest from utilities for both U3O8 and UF6, spanning delivery timelines from August this year into 2029. That demand has put upward pressure on bids and offers across all delivery points, with Coverdine and Orano reaching $71 for near-term material. So while the spot market may appear quiet on the surface, the underlying tone is increasingly bullish, driven by more active procurement and tighter availability. For uranium equity investors, this tightening is a clear signal that market fundamentals remain supportive and may be strengthening. Is this just the beginning of a broader price move? We'll be watching closely. If you haven't already, be sure to subscribe to Uranium Spotlight Podcast, available on your favorite podcast platform or on PurePoint Uranium's YouTube channel. The European Union is moving ahead with plans to ban all Russian energy imports, including uranium and nuclear fuel. According to a European Commission press release last Monday, this sweeping move could eliminate Russian involvement across the entire nuclear fuel cycle from mined uranium oxide to fabricated nuclear fuel. Last year, 23% of the EU's uranium supply came from Russia. Cutting that off will force 12 EU countries, home to 103 nuclear reactors, to secure alternative sources. For context, those 103 reactors represent nearly a quarter of the world's operating fleet and provide about 25% of the EU's total electricity. In countries like France, nuclear accounts for closer to 65%, and at times even 70% of total power generation. Not surprisingly, opposition has come from EU members aligned with Moscow. Hungary's Viktor Orban called the plan an attack on Hungary, warning of higher energy prices. Slovakia's Robert Fico went further, calling it economic suicide. Still, both leaders acknowledge they likely can't block the measure. If it wins a majority vote across EU states, it moves forward. The bigger issue now, where does Europe turn for uranium? Not Niger, once a key supplier, where a military coup has disrupted exports. Not Kazakhstan either, despite being the world's largest uranium producer. Roughly 90% of Kazatomprom's output is already committed to long-term deals with China and Russia. Australia, despite holding the world's largest uranium reserves, can't easily fill the gap. Uranium mining remains banned in 6 of its 8 states. Namibia, another major player, is drifting politically towards Russia and China. Chinese firms already operate several mines there, and recent deals with Moscow only deepen those ties. With no domestic uranium production to fall back on, the EU's best hope lies with Canada, the world's second-largest uranium producer. But that's easier said than done. Demand from utilities worldwide is already converging on Canada's Athabasca Basin, one of the richest uranium regions on Earth, and supply from that basin may be insufficient to meet the flood of new demand. For uranium investors, this is critical development. The geopolitical reshuffling of supply chains is tightening an already constrained market and placing even more strategic value on secure, politically stable uranium sources. Continuing our coverage of developments in Niger and their impact on the uranium sector, this week government forces reportedly raided the offices of French uranium producer Orano's subsidiaries in the country. Since the 2023 military coup, Niger's ruling junta has moved aggressively to wrest control of uranium production from Orano. The first blow came when they blocked uranium exports from the Somer mine, leaving an estimated $300 million worth of material stranded on site. Even attempts to airlift the uranium or reroute it through Benin were rejected, ostensibly due to security concerns. Next, the government seized Orano's Uranium project, accusing the company of failing to restart the mine swiftly enough. This is followed by the nationalization of Somer itself. Previously still operational, the efforts are now underway to sell the asset to new partners from Turkey, Russia, or China. This week's raids targeted Orano's Somer and Cominac subsidiaries, Cominac being a decommissioned site, as well as the company's overarching Niger office, Orano Mining Niger. Equipment was reportedly seized, and Orano has lost contact with its in-country representative. With Orano now escalating the matter to international courts, investors are left weighing the implications. Legal action may offer a formal route, but enforcement is difficult when dealing with an unpredictable and authoritarian regime. As the junta tightens its grip on Niger's uranium assets, the broader question for the West and for uranium markets is how to safeguard supply chains in politically unstable jurisdictions. All three major political parties in Denmark have now signaled support for overturning the country's long-standing ban on nuclear energy. This shift follows a significant announcement from a major Danish investment fund, which plans to raise 350 million euros specifically for nuclear energy and the broader nuclear fuel cycle, an investment signal that clearly caught the attention of policymakers. Two right-leaning parties were the first to publicly back lifting the ban, and this week the Danish Prime Minister added her voice, stating that nuclear power is a better alternative for Europe than continued reliance on Russian natural gas. As she put it, Denmark should take concrete steps toward repealing its nuclear prohibition. There are some differences in how the parties frame their support. The Prime Minister's Liberal Party emphasizes nuclear as a strategic energy alternative to Russian gas. The center-right moderates say they still slightly prefer wind and solar, but recognize nuclear could play an important role in a diversified energy mix. Meanwhile, the Venstre Party, further to the right, has gone a step further, calling for the removal of all barriers to nuclear research and development in Denmark. The political momentum now strongly favors a repeal of the ban, which would open the door to nuclear development in a country that has long opposed it. While timelines for building and commissioning reactors remain uncertain, the policy shift alone reflects growing European alignment around nuclear energy, an important signal for uranium investors watching demand-side developments. Sprott Physical Uranium Trust, or SPUT, has just raised $25.55 million US through a non-brokered private placement. That may sound modest by fund standards, but it's a meaningful move when you're holding one of the world's largest private stashes of uranium. SPUT now sits on 66.2 million pounds of U-308. To put that in perspective, the United States consumes about 45 million pounds of uranium annually to fuel its nuclear reactors. So SPUT alone is warehousing the equivalent of nearly a year and a half of total U.S. demand, and they've been crystal clear not a single pound has been sold or loaned out since its inception in 2021. CEO John Compaglia reaffirmed their strategy, emphasizing that SPUT is not a trading vehicle. It's a buy-and-hold physical fund. This latest raise is simply to fund operations, not uranium purchases, but it underscores their commitment to holding the line. In fact, Sprott Asset Management participated in the placement themselves. Post-financing, SPUT holds $31.4 million in net cash and boasts a net asset value of $4.64 billion. Their uranium is securely stored across Canada, the U.S., and France. For uranium equity investors, SPUT remains one of the most transparent indicators of long-term conviction in physical uranium, and a barometer for broader market sentiment. This isn't speculative trading, it's strategic hoarding, and it continues to tighten the tradable supply in a market that's already structurally short. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by PurePoint Uranium Group. PurePoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.